All right, it's Anne Marie Miller, right?
Yeah, Silva. I got married.
Dash Silva, okay.
3 minutes ago, 3 months ago.
And I'm sorry, can you tell us your company name again?
Yeah, Exito.
Okay. And so tell us a little bit about how you got started in the credit management, credit repair business.
For sure. Jumping right into it, huh? So I've been fortunate that like my dad grew up, was like, save, here's how you write a check and stuff. And so I had like some basic financial literacy, but I never like studied finance or anything. But he put me on as an authorized user when I was like 20. I didn't know what that was, but he was just like, you're 20, we should get you as an authorized user. So I didn't know, but he was building my credit already then. And then I met my now husband 3 years ago, and he had immigrated here from Venezuela. And so talking to him and talking to his friends, it was very obvious that like this whole credit thing was really weird because different countries, like I was just talking to another girlfriend from Mexico, for example. If you want to get a credit card, they'll check how much money is in your bank account, and that's the limit that they'll give you. This idea of unsecured credit is something that's like, I don't know, uniquely American, but it's just something that people that are coming here don't necessarily know. And so I helped him like build his credit, helped some of his friends build their credit. And then through an entrepreneurship network, I'd met several different entrepreneurs, and somebody was talking about credit repair, and I was like, oh, this is really interesting. Like I didn't know anything about that. And so that was kind of like 2023. So it was like late 2022, earlier this year. And then they kind of took me under their wing, and they're like, here's credit repair, here's how it works. You can do it. And I was like, oh, this is something I could totally do. And then, parallel to that, I've been fortunate to just be around a lot of people that are entrepreneurs. So for and then, I have a dog walking business on the side. So I've been kind of dipping my toes in the entrepreneurial water. And so when the stars kind of aligned and I met this person, I met several people that had different business models, and I was like, this credit thing, something I could do on my own, something I can launch, something I'm passionate about. I love education, something I have a background in, helping uplift people, empower people. And I'm bilingual, and I realized also that in the credit repair space, there's not a lot of influencers that necessarily cater to the Spanish-speaking audience. Mm-hmm. And so, plus having that experience of like, I'm a native and my husband is not a Native American, like, he wasn't born here, raised here. Having that unique perspective to talk to people who are either born here and raised here, don't understand credit, or coming to this country and have no idea what credit is.
Sure.
To be able to educate kind of that broad spectrum in both languages, and empower people. I mean, credit is something that's like really the basis of our society. If you want to do anything, buy a home, get a car, even if you take out a student loan, you're already building your credit, and people don't realize that,
Yep.
And so it was just this perfect trifecta of me wanting to kind of do something on my own in a space that, people, that I can help people and empower people. And then also, just my background as a communicator, it made a lot of sense to do that, so.
Nice. Well, so if I'm a client and I'm in need of some assistance, credit repair, building credit, how does that, what's your approach there? So if I come to you and let's say my credit's not great.
For sure.
What's that process look like?
Yeah, so we try to look at, one of the things I always say is it's not just credit repair, because there's really two parts to it. There's repairing your credit, and then there's also building your credit. So if you're someone that doesn't have credit, and let's say you take out that student loan, you're already building credit, even if you don't realize it. Mm-hmm. And so the repair aspect of it is, I have a collection, a charge-off, an account that has fallen to delinquency, or maybe they have my name spelled wrong, or my address is incorrect. That's when you talk about repairing the report so that you can improve your credit. There's a whole other part of it, which, involves a lot of partnership with the client to say, here's how you build good credit habits. Are you paying your bills on time? Are you making sure your utilization is low? Are you not making a lot of inquiries? There's more of the science of how do you, what is a credit profile, and what are the factors that impact it, and how can you build those good financial habits? And so that's why I like to call it more like credit coaching, because you might come to me and have, no credit or not bad credit. My husband was like, oh, when are we going to repair my credit? And I looked and I was like, we don't need to repair your credit. We just need to keep building it, because, so it's not a one size fits all. It just really depends on the case. But we'll look at, are there any things, like I said, the charge-offs, collections, bankruptcies, inaccurate information that are negatively affecting your score that we can improve? And then once those things are all cleaned up or at the same time, we want to be sure that we're focusing on that building aspect, because I think the misconception is like, I could take these bad things off and your credit's gonna like shoot up. And that's not how it happens. You can take the bad things off, but your credit, if you don't have those other things aligned, it's not gonna just skyrocket.
Yeah.
So you have to be, proactive about the building aspect of it too, building those good habits.
Right. So in terms of like disputes and charge-offs and things like that, I mean, is it good for, because I see a lot of credit reports, and, I've always been under the understanding that if somebody's disputing something, it's not necessarily impacting their credit score because it's in dispute. Is that true?
So it can become an issue if you're taking out a mortgage. So I had to watch this, right, as I'm like applying for getting my first house, because I think the financial companies, mortgage companies can't do stuff, or you can't really move forward the process if you have an open dispute. Some
things can be disputed. Some of it depends a little bit on the whole picture, and the type of financing you're doing. So,
totally.
There's been instances, and the reason I was asking this is because there have been instances where, we have to remove a dispute, and the only way to then update the report is to actually then pull a new credit report once that's been removed. And 9 times out of 10, when you remove that dispute, score drops, and then that can create potential issues.
Interesting. So, I mean, it'll depend too on what you're disputing and when you want to do it. Can you go back to the question again? I want to make sure I'm answering it.
Oh, just talking about disputes and how those impact scores and.
Gotcha. So if you have a negative, if you have something negative on your account, so basically, let's go like to the back. A dispute is basically you go into the credit bureaus. There's 3 credit bureaus. Well, there's a lot, but the main ones are Credit, Experian, Equifax, and TransUnion. So they all basically get your information from a larger company called LexisNexis, which people may or may not be familiar with. And so they'll go to LexisNexis, collect all this information on you, and then throw that into a mathematical formulation, and that'll be your credit score, depending on your payment history, how often you ask for credit, your utilization, and those 5 basic credit factors. Now, if that information, either from LexisNexis or when they get it from, say, I go to you and I apply for a mortgage, that mortgage, company is going to report that to the credit bureaus. If there's something incorrect there, or I had a loan that fell into delinquency, that's been reported to the credit bureaus, you might want to do something called a dispute, which is basically you going to those 3 credit bureaus and saying, hey, this thing on my report is wrong, and please verify it, and if not, please remove it. Because by law, under the Fair Credit Reporting Act, everything that they say has to be correct. The thing is, they're updating that information monthly, and so something that may be correct one month might not be correct the next month. And so if it's something like I said, a collection, a charge-off, a bankruptcy, maybe, after bankruptcies, depending on the bankruptcy type, might be 7 or 10 years. If, say it's year 11 and they haven't gotten that bankruptcy removed, you dispute that, then it's going to improve your credit score. So disputing is not necessarily a negative thing. And then the other part of it is that, which we can get into a little bit later, just because you send the dispute doesn't mean that they're going to do the thing that you ask them to do.
Right.
And that's when the process can get a little sticky. But I don't think it should negatively impact your report. Like I said, it might, in the case of like trying to get other credit or a loan, it can hold up that process if you have anything that's open on your report. Because again, that can affect your score.
Right.
Whatever the outcome of that is.
So I know sometime maybe in the last year, there was a change to how medical collections were going to be handled. And I can say, I can't think of a credit report I pulled in recent memory that had any medical collection. So are they just stopping reporting that? Or how?
I'll look at my phone and we can like re-record this part. But because I actually had a client or a potential client, and they had some old medical debt, and they had realized, I think it was like, to your point, I think it's like 2019 or 2020. They basically have this new rule that says that kind of any debt that's under a certain amount, I think $600, but I'll verify, they're not going to report that on your credit report.
Okay.
So it's like basically if you had a credit card that was less than $600, they're not going to report that. But if as soon as your credit hits 601 or, but it's, in this case, it's medical debt. So if you have a medical, like I have a $30 copay I didn't pay and that went to collections, that's not going to be reported. And so that's huge because a ton of people in the US, and this would be a great stat to pull, have medical debt, which can negatively impact your ability to get the house, your ability to get new credit. And so in order to kind of add more equity to the system, they're going to basically hide that debt or just not show it. Once you have 601 or 602, or if it's before the time frame, which I think was what happened with my client, they had a debt from like 2018, which didn't qualify, so they couldn't get rid of it under the new law. But if like, you came to me today and you had, again, that $30 copay from earlier this year or last year, by law, that shouldn't be on your report. And that's something that you could dispute and say, hey, this shouldn't be here. This is inaccurate. Let's remove it. And they'll do that. And that should help your utilization. And
yeah, I know with like FHA financing, they, obviously if you have medical debt in collections on your credit report, that will impact your score. But FHA financing, won't consider those balances or payments, which is really good. But yeah, I appreciate you explaining that, because I remember hearing something about how that was all going to change. So that's good to know. A good question I had for you, because I get it all the time, is, oh, hey, Credit Karma says my score's this, but when you ran credit, my score's this. And the way that I explain it to people is they're different scoring models. And it can go either way. I've pulled people's credit and it's been higher than what they're seeing, and the opposite tends to be more true. But maybe you can talk a little bit about.
Yeah, there's tons of scoring models. The main two that people are looking at is going to be your FICO or your Vantage score.
Yep.
This is something I actually have a video about on my thing, because people are like, what's Vantage? What's FICO? They're basically two different mathematical models that will take into account, your debts, your payment history, those basic factors. And depending on which model you use, it's going to calculate and spit out a different number. So I love personally the Experian app. This is not an ad. I don't get paid for this. But I love the Experian app because it's free and you can see what your FICO score is. And not only that, so what I'd say, there's not only that, it'll show you actually like your FICO auto, your FICO home. And when I went to apply for my loan, what was on the FICO, same thing, because it'll say, let's say my score and my FICO when I open my Experian app is 750, but I look at my FICO home and it's 728 because it's a different scoring model. But you can look all of that up for free in the Experian app, which is why I like that a lot. But basically, again, two different scoring models. You have FICO and Vantage score. Credit Karma is going to be very different when you're looking at the Experian app, because they're using something called a Vantage score, which is like their attempt at trying to create a more equitable credit score. So they'll like count more things, or maybe if you see like, oh, add your bill or add your rental history, because they're trying to find other ways to add more values to try to get a more accurate score, for maybe populations or people that might have historically or with the FICO model not have as high of a score. And so that's the biggest difference. But you can see your FICO score if you make an account. Like you can, if you download all the apps, Experian, TransUnion, and Equifax. You download each of the apps and make accounts. You can always at any time find that FICO score. But you want it, and the same thing on your banking apps. Like I have, Chase. It'll say, here's your credit score, and you have to look under in the little, it's like little very light text, the fine print. But it'll say this was calculated using your Vantage 3.0. And you want to keep an eye on the one that says FICO, because I always tell people like this is the one that the car companies are using. This is the one that the mortgage lenders are using. The credit card companies are using. But the Vantage is a helpful model, but not everybody is going to use that. And it's definitely not going to be used when they're looking at your home score.
Yeah, and I'm sorry, I didn't mean to interrupt you earlier.
No,
I was just going to comment on the utilities. So I see that a lot on people's credit reports. And luckily, those report a certain way, and we know their utilities, and so you can actually omit them. So even if it says, $30 a month, $100 a month, we can omit those, so you don't have to count them in their debt obligations, which is nice. But I know that can help kind of boost your score. I like what you said about the different apps, because you can go sign up for Experian and TransUnion and Equifax accounts, and I always think that's great to do, and you can get your scores, but you can also manage like your credit freezes and things like that. Yeah, every time I try to log into one to unfreeze my credit, it's like I never remember what my password is, and then I don't know what my code is, and so it's always kind of like, a fun little game of me trying to remember my password and then resetting it constantly.
And you have to keep an eye on that too, because again, Credit Karma is free. It'll only show you your Equifax and your TransUnion, but again, your Equifax and TransUnion Vantage score is going to be different than your Equifax and TransUnion FICO score, which is part one. Part two of that is different companies. I don't think you really need a third party. There's a lot of like obscure name third parties that'd be like $25.99 a month, and we'll send you your scores. At any time, you can get one free annual credit report from all of the bureaus. And then again, I like Experian because it's a free app. I can see my FICO score. I never have to guess. And then I think it's every 90 days, even if you don't pay for I pay for the $25.99 a month because it's nice to every 30 days see across the 3 bureaus in one place where it is. But I think if you just have the free model, it might be every 90 days or something. It'll actually update your Experian and your TransUnion for you for free, and then you're seeing your FICO and you're seeing it accurately. Just because honestly, I don't have the patience to download Experian.
Yeah, I mean,
Equifax, but you can.
Do you think that those consumer-facing things like Credit Karma, or like, you know, if you have a Capital One card, you get a score, or even through like your Chase app, do you think those are good ways for people to kind of gauge where their credit's at, even though it's not, you know, I guess the coup de grace, the scores that are going to be used?
Yeah, I think like the first thing with credit always comes to awareness. Like, I can't, you know, there's probably tons of people that don't even know how to check your score. Yeah. So that's like step one. Do you know that you can check your score for free in these places? And then like the deeper part of that is like, you know, if you are thinking about looking for finance for a home or an auto, you know, talking with your, you know, either your credit repair specialist or your credit coach or your realtor mortgage finance person that can tell you, that's great, you have an idea, but like, this is what I'm actually gonna run, and so this is what you need to keep an eye on, which again, I like that. My favorite, you know, is just Experian, but also because within the Experian app, or if you open it up online, it'll show you that FICO home that you're gonna be looking at when you're running my credit for a home. And that's like invaluable. Because I'll be like, oh, yeah, like they ran mine, you know, and it was like, let's say 730s, and I was like, but it says 760, and then I realized it's like the FICO home, different scoring model, it's gonna be different. And so that's really useful. I think the awareness is key. Again, and then another thing that's nice too, like I really like in the Chase app that you can play around with it. So it'll be like, if I pay off these debts, if I open a new credit card, which they have a scoring simulator, I think in FICO also, or it might not be available if you don't have the, you know, unlimited or the paid version. But those are also really nice tools. So if you're planning on buying a house or planning on opening a new credit card, you can kind of test to see what it'll do to your score before you make that decision. And that's super useful information to have.
Yeah, so pretty much every lender has it, but you know, through the credit companies that we use, there's always like some kind of analyzer tool that we can run, you know, and it'll say, okay, you know, you do these things, your score should go up. Most of the time it's paying down credit cards, which I think before we started filming, we talked about that a little bit, that's, at least in my mind, you can correct me if I'm wrong, is probably the easiest way to get your credit score up, is paying down revolving balances. Or like removing authorized user cards or things like that. I mean, I've had clients who didn't have very much credit, and you know, let's say they were applying with their significant other, and so the significant other has an 800 score and they have a 670. You know, what we'll do is then we'll have, you know, borrower 1 with the better credit score, you know, add borrower 2 as an authorized user. And that turn time typically like 30 days. I think it depends on when they report to the bureaus. But those are great ways, like if you just have low credit because you don't have very much history, those are really great ways to get scores up in a quick time frame. And you said it too, I think before we started filming, or maybe you were talking a little bit about it at the very beginning, which was how your dad had added you as an authorized user. And that's something I see a lot too, where I have younger clients and they've got a credit card that was open, you know, like before they were born, which is great because obviously that starts building credit very early when you add them on there. But then sometimes those balances are really high, or, you know, they have a high limit and they're carrying a balance. It might be a debt that we have to count. Luckily, there's ways to omit it. But maybe we could talk a little bit about how, you know, if you have kids, like when's the right time to start thinking about doing stuff like that? Because like I have a 15-year-old son, and you know, probably in the next year or two, I'm thinking about adding him as an authorized user on one of my cards. Obviously, I'm not going to give him a card. But
no, I'm glad you mentioned that because it's something that it's like one of my favorite facts that people don't know. Even people that work in the banking industry, you can add a kid like as soon as they're a day old on a lot of cards. There's
as soon as they have a social.
As soon as they have a social, yeah, I guess, yeah. But very good point. But a lot of people don't know that you can, you don't have to wait till they're 15 or 16 or 20. As soon as they have that social, you can add them as an authorized user, and then they'll be 18 and they'll have 18 years of credit history, which is a really great trip. It's not for all banks, and there are articles online that will tell you, like, here are all the banks that allow you to do that and from what age. But that's, I think, like one of the coolest hacks you can do for your kid is, like you said, sign them up, get them building that credit history under their name. And then in my experience too, like when I started, again, getting into the credit thing, obviously my dad had started that credit for me when I was 20. Two things. One, more recently, I was like, hey, Dad, like, what other cards do you have that you don't really use? I found he had like a Discover card that was like 20 years old. And I was like, hey, can you add me as an authorized user? And so that helped, it's not going to completely copy over, but it'll help boost your credit age a bit and stuff. My credit age didn't automatically go to 20 years, but it'll add some more of that credit age, which is really, really good. Authorized users. Amanda left me.
Does that also apply to people getting just a regular debit card that's connected to their bank account directly? I know some of them, they call them debit credit cards, but necessarily all they're doing is just pulling money from your account. It works like a credit card. You don't always have to put the PIN in, but is that going to build your credit?
I think you're talking about, like, it depends on the card. I know BMO has this great new product, like they have two products, but it's like, again, I'm not paid. This is not an ad. But I love BMO. They have the secured credit card and like a secured loan. And so basically, if you have no credit or really, really poor credit, you can get something called a secured card, which is similar to that Mexico model, where you'll give them $500 and that'll be your credit limit. You'll use it and then, or say $200, whatever. They have different basic limits. So you'll use that credit card to whatever the limit is and then just pay it off every month. And then after, say, 6 months or whatever the time limit is, they'll turn it into an unsecured card and you'll get your money back. So that's kind of their way to hedge their bets on, like, you have no credit, you have really poor credit. You can build your credit. Like I said, BMO just came out with a secured credit card, which I'm excited about. They also have something called like a secured loan, which is basically like you'll pay the money, but it'll go into like a savings account. But they'll report it to the credit bureaus to build credit too. So there are different credit builder products out there. So but if it's not one of those,
I was curious about it because, like, when I got a job at 14 washing dishes and opened up a bank account, they gave me a debit card and it didn't do anything. Like, I didn't have a credit history until I started a college credit card at 21. And I got $600 worth of credit. And that was all that I had to build my credit. And that also kind of helped tank my credit a little bit when I was in culinary school. So I had no history, and that was linked to a debit card. They said it works like a credit card, but it only just comes from your checking account. So it wasn't necessarily anything that built credit. And the more we go through these things and working with people, seeing that they have, blemishes or areas that they can improve, then you can kind of start working on like building a timeline and mapping that roadmap for purchasing and getting those approvals. So, having this understanding definitely helps a little bit more, I believe. So,
yeah, you want to make sure it's reporting to the credit bureaus so that you're actually building the credits. But authorized user, like for someone that doesn't have credit, that's one of the first things we'll recommend. If they don't have credit or don't have great credit, is to get on an authorized user card. Now, if the authorized user has really poor credit, it's not going to help you.
It's not going to do any good.
But like in the case of the, my mortgage, to your point, there's like, oh, we see these cards, and it's just very easy to tell the lender, hey, my dad's paying, that's my dad's card. Can you omit this, please? 'Cause it's
you can show a history of that person making payments for the last 12 months, and then you're able to omit those liabilities, which is great. And, in some cases you have to do it. In others, like the debt ratio is not really an issue, so it doesn't matter, and you just kind of move on. What was I going to ask you? I
had that second authorized user point, and then totally.
So, I get a lot of people that, obviously they have credit cards, which are revolving debts, and then they have installment debts. And I've always heard that if you pay off installment debts, it can hurt you. Is there any truth to that?
Oh, that's a good question. I think, that's a really good question. You can check the simulator tool. The thing, we always like the revolving debt because it it's open, and as the longer that's open, it's going to keep adding to your credit age. Once you finish that, you might see that slight decrease because now that account, it won't be open anymore, essentially. It'll be closed. And so the number of accounts you have open, you want to have open accounts that are revolving and installment, which will add to your credit mix. It's only 10% of your score, 10 or 15%. So it's not a huge drop that it is going to, but you might see a little bit of a drop, and that's because you're changing from having this open debt to a closed debt. But the other thing with maybe I was going to say this with the authorized user, the other thing really, really important when it comes to building credit is that payment history. If you miss a payment, it's like, you can't go back in time and fix that.
Well, yeah, and I tell everybody, listen, it's one thing if you're a few days past the due date. As long as you're not 30 days late, nothing gets reported. So, sometimes people forget or they get hit with like an annual fee and they don't realize it and then it rolls over. So
this actually just happened to me where I have my one loan on autopay, didn't take, and it's like, you're 2 days late, but it won't report for 30 days. So when you have that, it's like, oh my gosh, they understand things happen. What you don't want to let it do is get to the 30, 60, 90 day mark, because then that's going to look really bad. And for me, it really sucks because it's something that you can't go back and erase. You can mess with your usage. You can mess with, how many accounts you have open or closed. But if you miss that payment, there's like no going back in time and fixing it.
Yeah, it's like, I know, just from clients trying to do it, it can be pretty hard to get stuff like that amended. But that's why they work with, somebody like yourself that's going to be able to coach them through that and actually assist with those repairs. Oh man, I forgot.
I know.
We keep diving into such good information that I'm like, I've got my next question queued up.
That kind of made me think of a thing as well, because if you do have those late payments, and then you have the late fee that happens after usually like day 3 of being late, and then they charge on, whatever, $25, $35, whatever those fees are. If you are paying that off within that 30-day window and you call your creditor, you usually can get like 1 or 2 of those late fees reversed, and then you can have that given back to you, which I did not know that until I started reading books about repairing credit and tackling these issues with my wife and building our credit right before we got married. So just having that ability and knowing that you more than likely can get, a few of those taken care of a year, that saves you a whole bunch of, further damage that can happen from just, excessive late fees and then going delinquent 30 days or seeing things go past 60 days, stuff like that, and getting those erased.
And the best way to avoid those late fees, I always tell people, is that minimum payment. You want to keep an eye on the minimum payment, because if you pay, if you pay less than a minimum or you're late on that minimum past the 30 days, you're going to tank your credit history. And for some things, it's like your minimum payment's like $30, $40. It's not terrible, even, you might be tight or whatever, but it's so important to pay at least the minimum. Obviously, you're going to be dinged with the interest or whatever, but it's much better to at least have that minimum so you're not affecting your payment history, because that can do that's one of the most important things on your credit, and it'll do damage so much faster than anything else.
And that could be the threshold that you set your automatic payment at, and then 100%. When you know you have more money at the end of the month, you've made all your other payments, you can make an extra payment on there and then knock that credit out a little bit faster.
Yeah, and now I remember what I was going to bring up, which was about auto payments. And a lot of people, myself included, you're relinquishing, I guess, a level of control with auto payments. And I'm the type of person that when I sit down to pay bills, I just want to get everything done right now so I know it's all coming out, and then I can move about with, my life. But I have everything set up on auto pay, just because that way, if for whatever reason I forgot or whatever, it's going to go through, and I know that I'm going to be fine and not have to worry about any late fees or it dinging my credit or anything like that. The other thing I would say is probably don't ignore things you get in the mail. So here's a story about myself. So we have an investment property and had, when we bought it, we had to transfer the utilities and everything like that. And then when the tenants took over, they transferred the utilities. There was like a little bit of a confusion with the gas company, which if you've ever tried to deal with people's gas, they're a nightmare. And what I didn't realize was the tenants had switched it over, but there was still a balance left over. And, you know, I don't remember getting any phone calls or anything in the mail. And then one day I get like a pink thing in the mail from People's Gas. It's like, hey, you need to pay us this, we're going to report it. So I called them and got everything taken care of. But, you know, it just like, you don't want to ignore those things that come in the mail because they're not always going to call, they're not always going to email, you know, and so you want to make sure that you're paying attention to that stuff so you just don't fall behind on anything. And again, once it goes 30 days late, like,
I don't think they ever call you.
I don't either, but you know, it's one of those things where it's like you have to pay attention to that stuff so you don't end up in a position where you get that 30-day late, and you know, it can be very difficult to remove. And I think even for most creditors, if you're in a position where you're coming up on that 30 days and you call them and you say, hey, I'm going to pay it, you know, in 3 or 4 days, they'll usually give you the grace period. I don't know if...
I haven't had I haven't personally been in that situation, but I think, like we've talked about before, in any case, any way you can call the person and say, hey, this is what's going on, you know, or I need help with my bills. Mm-hmm. Like, I think that's another big thing is like, if you can't even make that minimum payment because you are really going through financial hardship, like you said, you don't want to ignore the letters in the mail. You want to call the company and tell them, hey, look, this is happening. I'm having a rough time, to see if they can put you on a payment plan, if they can extend some of that grace or give you another grace period so that you don't end up with a late payment if that's really the situation that you're in.
Yeah, I mean, I know people that have done that before, and obviously during COVID, there was a lot of that stuff happening with mortgages, which was the emergency forbearance, and that is something that's always been around when it comes to mortgages, is forbearance. You know, it was always more the burden of proof in the past, like you had to prove financial hardship, but then during COVID, you know, it's just like, just tell us and we'll put it in forbearance pretty much. And, you know, we had to go out and tell people like, listen, if you don't need to do this, don't do it, because typically what's going to happen is that interest, or if you are escrowing property taxes and insurance, all that's going to get tacked on later. And especially with FHA loans, it basically gets turned into a second lien on the property. And I had people go to refinance and they didn't realize that you also have to include this balance in what you're refinancing, and that can cause issues.
One quick note on the auto pay I wanted to mention is that I'm like you, I love auto pay because I will forget even if I have the reminders on my phone, but auto pay is great. And then with the credit, because, you know, like you said, you don't have to think about it, but then also different credit card companies will actually allow you at least once to change your due date. So What I like to do is, like, I know I'm going to get paid on X day. I like to maybe the next day or in those next 2 days make all my bills due, so that as soon as I get that money in the bank, all of my bills are paid, and then I know whatever I have left I can, you know, use to manage the rest of the month. But it just takes so much of that stress out, like off your shoulders, to know, you know, I got paid, all the important things are paid, I'm not going to fall into late payments or anything like that. And then you can just go on, you know, living and spending or saving or investing however you please. Yeah.
Finding that balance is, I can't stress how important that is, because before I got into real estate, I was a chef. My wife gets paid twice a month. I got paid every 2 weeks. Mm-hmm. Paychecks were never really ever very consistent at timing, but if we were allowed, we divided all of our expenses, you know, rent and then a few credit cards at the beginning of the month, and then the other credit cards getting closer to the latter half of the month, around like the 20th or whatever. So that way we at least knew on her check on the 1st and the 15th, we always had some bills that were going to get paid right away. And then my 2 weeks, you know, sometimes that filled in on the 12th, sometimes that was the 3rd, sometimes that was the 25th. Like, whenever those things were coming in, we at least knew that there was always going to be consistent money to pay to the first half of the month or the last half of the month. And then that keeps you on a much tighter track of on-time payments and getting you on top of that stuff, which builds credit. And, you know, when I was leaving culinary school, I had deferred student loan payments for about 10 years. And that doesn't do anything good to your credit. I was starting at like a 500, 525 area. And in the span of a year and a half, 2 years maybe, I built that thing all the way up to like 760s. Just by having on-time payments and relieving like a little bit of back debt. and activating, you know, my income-driven student loan payments and, you know, actually engaging and proactively tackling that debt. And a big factor of that was splitting things up into the month and knowing where your money's got to go exactly at what time, and then having it auto paid for that. And it just opened up the door to like so many different things.
Totally. When I used to be biweekly, now I'm monthly. But when I used to be biweekly, every 2 weeks getting paid, I would do something similar. If I knew, hey, I have this bill at the end of the month, take a portion from each of those paychecks, like say my rent. I take half the rent from my first bill, half the rent from my second, from my second paycheck, and then by the time rent came around, I was ready to pay on time. So I think that's super important. Now that I love to just get the money, like I said, take everything off that I know it's not mine, aka all my bills, and then you have that freedom to just know, okay, whatever is left, that's what I've got. You can move forward with that.
Yeah.
To your other question too, you were saying, you know, one of the easy ways to help build credit is authorized user, and becoming an authorized user, and that can be a great tool if the person that's authorizing you, again, has great credit. But the other thing that people don't realize that is really effective is honestly like paying down the debt, because usage is so huge. Like I have one client that's maybe in the like 560s, 570s, and all they would have to do is literally pay off like $1 or $2 grand to get that usage down to minimum 30% or whatever it is. That'll shoot your score up. That's like one of the quickest things you can do to shoot your score up, is getting that, seeing what your usage is. First, you know, the first goal is always getting that to 30%. And then, you know, everything you can get to closer to zero, obviously. But if you can't, you know, again, payment history, making those on-time payments, and then usage. Usage is huge. People don't realize how easy it is to just get that score back up once that usage comes down below 30%.
So 30% is kind of the magic threshold. Okay.
Obviously, the closer to zero you can get, the better. But I always say for someone who's like, you know, I said their usage, they have a unique situation because they don't have business credit and they're using their personal credit to finance business, which is a whole issue that we can get into talking about. But yeah, for people that are at that 40-50%, if you can figure out a way to get that usage down, which adding an authorized user might help because that could raise your credit limit, so that'll affect your percentage balance, you know. Because again, $100 of $500 is 20% usage. $100 of $1,000 of credit is only 10% usage. And so, you know, you can mess with it that way, but getting it to that 30% mark is like always the first goal that I have for clients. And then obviously the closer, and you can get it to zero, the better. But yeah, 30% is kind of the magic.
Okay. Well, since we're getting into this a little bit, and I know we touched on it in the beginning, but tell us a little bit kind of what the typical process looks like. You know, obviously it can be a little high level, but just kind of just start to finish, you know, what happens when a client first comes to you.
Yeah, for sure. So we've already gone over the dispute process. Basically what it is we're going to the credit we're looking at the credit report, saying, okay, A, B, and C are inaccurate. We're going to go to these 3 credit bureaus and we're going to say, hey, this is wrong, please fix it. So that's basically disputing. Anybody can do it. You can do it for free. You know, the service offering that we do it is that we take it off your shoulders, so you don't have to worry about it. That's why you might want to hire a credit repair specialist. You're like, oh, this is one more thing I don't want to think about, you know, credit repair, or in my case, you know, credit coaching. So the first thing we'll do is we'll bring in a client, we'll take a look at their credit reports and provide them a free analysis. It's a super important thing for people to know, and I know we'll get into it later. You get a red flags question. Is anybody that is like, give me money now and I'll do this, or it's illegal under we have something called the Credit Repair Organizations Act that regulates credit repair organizations. And one of the rules in there is that you cannot receive money before providing a service. So we always do a free credit analysis as our service, but we'll sit down with you and say, hey, here's what's affecting your credit. Here are the steps. Here's the things you need to remove if you need to remove, if you need to repair, or here are the things you just need to build to get that credit up. And that's really useful too, so then we can provide a plan for our clients. So we'll say, you know, my mentor, he's been doing this for 7 years. His mentor's been doing this for 10 years. So there's a lot of collective experience there. And they say the average client is maybe 6 months. But again, it depends. I might have someone come in and it could be 3 months. And it could, you know, 3 months of repair or 3 months of building. Or like, you know, some clients that have, you know, a collection, like a really charge off or a bankruptcy or something. Then you're looking like closer to 9, 10, 12 months. But a good average is like 6 months. And during that time, we're taking them through that steps. Here are the things we're repairing. We're going to repair that. And then at the same time, in our case, we're building an action plan for how they can also build their credit and what are the habits they're doing, checking in with them monthly to say, hey, how's this going? Here are the factors that we want to work on in your credit score to make sure that we're building at the same time that we're repairing their credit.
So, and maybe this kind of goes into some of the misconceptions, but do a lot of people feel like they can just come to you and you just delete all this stuff and like everything will be fine? I mean, because honestly, 3 to 6 months, even 9 months is not a bad time frame at all. I mean, I have a lot of people that come to me just to get that process started, like the pre-approval process started, and they may not be looking for 6 months to a year. So, I mean, that time frame is not bad at all. But would you say that, do you think that people come to you and think, oh, she's just going to get everything deleted and like my score is going to be perfect?
Yeah, and again, this is, red flags. So the first red flag, again, is like anybody that is coming to you and saying like, I'm gonna increase your credit by 100 points in 30 days. 1, by law, we cannot say that. We cannot give you any promises like that. 2, as we talked about before, the credit repair companies are fickle. I could go to them and say, hey, we want to dispute this. And they could be like, nope, all right, next month we're going to dispute it again. Because I don't have any control. While you spend the dispute, you don't have any control over whether they're going to remove the information or not. Mm-hmm. And that can change the process. The other thing is the calculations, right? You can get that thing removed, but I don't have a crystal ball that's going to tell me this is going to increase your credit by 25 points in 30 days. So anybody that's making those kinds of promises or asking for money up front, those are huge red flags. And we mitigate that by saying we're going to be as transparent as possible with you. We're going to give you the free credit analysis. And we know that if you take steps X, Y, and Z, your credit is going to improve or it is going to tank. Mm-hmm. And that we know because that's just how the calculations work. It's, there's 5 factors that affect your credit. And if you mess with those factors, you're going to know the general direction that your credit is going to increase or decrease.
So what are sorry, go ahead.
I was going to say, is there ever a scenario where it might actually be the right idea to have somebody file bankruptcy?
That I can't speak on. No? I'll do my homework and go back to you.
It's obviously something you can't really like advise, right? You can present people their options. Mm-hmm. I had a client years ago who I helped her buy a home. She was going through a divorce and she bought a condo and she loved it. And then a couple years later, she kind of calls me out of the blue. She's like, I just need your advice. Like I got into kind of this bad situation with somebody. It was a real estate investment and like now it's all on me. So we kind of talked through the possibilities, but I was like, listen, I can't tell you like bankruptcy is the answer and it's not what I do. But, if it's the only way you think you can get out of it, you should talk to somebody. But I mean, it was a very difficult situation. And obviously there's nothing I can tell her, yes or no, this is the right way to do it. And I'm sure you're in the same position.
Yeah, I've only had one client come with me to a bankruptcy and I don't even know how they got there. I would rather work with people as early and often as possible. Like you said, it's great when people can come to me and say, hey, in a year I want to buy a home, or a year, I had this one client who's like, I want to buy my building. I don't have credit. My credit's terrible because I don't have business credit. Okay, let's get you on a plan to build your personal credit so you can qualify for that business credit. So then your personal credit will be good enough to get the loan. We want to be working with people as early and as often as possible, but yeah, one of the biggest misconceptions is that like this is a quick fix, and it's not. You can, and then anyone who's telling you that is you should run the opposite direction.
Absolutely.
So it's not like a diet, right? It's a lifestyle change.
Yeah,
100%. And that's where it comes in, like the coaching, like we talked about before. Are you paying your payments on time? Do you know where to find this information? And again, the education factor, like working with my clients to know, do you understand your credit? Because the worst thing for me is that, hey, let's say I help you repair and build your credit. And you come to me a year later and you're doing the same thing. That's not a successful story for me. It's discipline. And so and that's where I think too, one of the biggest distinctions with Exito and what we're trying to do is not just like repair your credit and get out of here. Like we want to help you repair your credit if you need repair, build your credit, get those good habits, and then also be connected to the financial resources and know, hey, here's a lender who can help you out. Hey, here's a realtor who can help you out. Hey, here's people that we trust that can help you on the rest of your financial journey. For me, that's a successful client story.
Yeah, and I feel like, this is really stuff that they need to be teaching in high school. I mean, finance, credit, it just needs to be
gotta get it into those Montessori schools.
Yeah, well, obviously, God bless my parents, but growing up, like, we never talked about money, and we never talked about any of this stuff. And so, when I was like 22 or something, like, we bought our first car, and I put it in my name, and I didn't have any credit, and I had to have my dad co-sign, which he was not happy about, but he was like, you better never miss a payment because that's going to affect my credit, and I have perfect credit.
Yeah.
That happened with my mom as well, with a car and then also apartments and everything else. It's like, when can I just not need my parents?
Yeah.
And be a real adult? But, like, they don't teach any of this stuff in school. They don't teach me,
they really,
for sure.
really should.
And my father passed away when I was relatively young. He managed all of the finances. He was the breadwinner. My mom was stay-at-home mom. Additionally would make like extra income cleaning houses or whatever, but it was all like cash from old ladies. And I usually had to do all the vacuuming. So, once that family structure like fell away and we didn't have that, like, my mom had to completely learn how to manage money. And she's not even the best at it, but she somehow, skated her way into having really, really good credit. But she didn't have a way to teach me how to do that. She didn't have a way to like show me a good way to do things. It was just like, pay everything on time. Like, okay, that's cool, but what if I don't have any money? It's the hardest thing to really show people how to do it. And if you can get it started very young and very early, and like, now they even make board games of like how to introduce this into your family, of like paying things on time and doing all of that sort of stuff. So have you ever played the cash flow board game from Rich
Play
Dad,
Monopoly.
Poor Dad?
That's probably completely the opposite.
It starts out as like learning how to manage small finances, and then it turns you into like a big investor where you're like on the...
Interesting.
It's a fun game. I go to an investing group like once a month, and we play that game on Saturdays. And you'll do it for 2 hours, and then we talk about
Does it get like hyper
investment
competitive?
Yeah, and we have like different groups around the table, and we'll just call ourselves a different state, and we're like, hey, what do you guys got for investments over in Missouri? And it's like, we'll buy your deals over there, and we like interconnect, and it turns into a big fun process. But like, the more and more everybody picks up on it, like, there's newbies there, and there's guys that have been playing it for 10 years and seen the whole game like evolve. But the more financially savvy everybody is, real estate's going to be one of like the number one financial tools for generating, generational wealth.
Mm-hmm.
And teaching that to your family so they can manage it after you're gone. That's only going to help broaden it and continue the growth. Otherwise, you get to the situation where my family was. I'm the last generation that's going to receive family wealth from, my great-great-grandparents who started the business. And, my aunts and uncles are ahead of me, and I got my father's portion with my little brother. But after them, that has to grow some way with my aunts and uncles to pass on to their kids. I didn't get as much, that's 50% share of 25% of family. Sure. And I have to figure out how to make that grow to help me, and my brother has to make that grow to help his family and continue the thing to go on. Otherwise, we just squandered what took 4 generations to build.
Yeah.
To your point about the education piece, I think, obviously it is a shame that a lot of this stuff isn't taught sooner, but also for what's crazy to me is that, you have 18-year-olds coming out of high school that are signing documents worth thousands and thousands of dollars.
Tens
of
thousands
or $100,000 of dollars. And that's building their credit. I think that's one of the first things that people probably have on their credit report is even before my dad made me the authorized user, I had student loan debt. Sure. And that is building your credit, and that's going to affect your credit long term. And we're not taught those things. So I think to your point, like at the very least, when you're signing those, you should get a credit basics course on like, hey, by the way, signing this, you're starting your credit journey.
And student loans are the only thing you can't get away from. Like not even a bankruptcy will absolve you from student loan debt.
Just gonna have to hope Uncle Joe comes through.
Unless you're somewhat lucky like me and you went to a predatory culinary school that got shut down, and all of their federal loans have to get paid back in a big giant lawsuit. So I lucked out there.
Well, how do you? Well, I guess tell us how much your services cost. So is it kind of like a one size fits all? Does it depend on the situation?
Yeah, totally. So again, one of the biggest red flags is if someone's like, pay me your money and I'll repair your credit. Honestly, in any situation, you should probably run the other way.
Sure.
But especially when it comes to credit repair, people that are saying like, hey, pay me $1,000. I've had clients come to me and say, hey, I paid someone $1,000 and they didn't do anything. One, that's illegal, and two, again, can't make these upfront promises. So we operate on a subscription model where we do $99 a month and just a down payment of $99 to help, processing fees and all that, just a startup cost. And again, because off that free credit analysis, we're going to know, are you a 3-month-ish case, a 6-month-ish case, a year case, and then we give them that option to, again, opt out at any time. I could say, hey, over the course of this year, it's going to be, say, $1,200. But if we get your credit fixed in 3 months or 6 months, like, you're good to go. You don't have to keep paying. And so that's why we do the subscription model. And again, $99 down, $99 a month. And we'll adjust those quotes according to the case-by-case basis. And one other quick note, again, by law, you shouldn't be doing any credit repair stuff that you're not signing a contract for. And in the credit repair law, you have to give people 3 days to say no. So I could have someone say, hey, I want to do your credit repair services. 48 hours later, they're like, just kidding, can't do this. By law, they have a legal out. So you want to be sure that, you're reading the fine print, you're doing things the right way, and that you're operating with someone that, is reputable and
operating with integrity.
Exactly. Yeah. If you know that you want to buy a home or make a big purchase, just like you should be talking to your realtor and talking to your lender to get into that plan, you want to be talking to them honestly as soon as possible, even if it's a year out, 6 months out, so that if you are someone that needs credit help or other kind of financial adjustments, they can refer you to a credit specialist that can help that can help you on that process to get whatever it is, the DTI aligned, get some of those credits and credit disputes going and things, so that by the time you are ready to finally buy, you can have a pristine credit report to get the home. So it's like, I try to tell people, it's not, if you have bad credit, you're going to have a really tough time getting a home, but it's not the only thing that people look at. Right. So we're just a partner in this process with the mortgage lender, with the realtor, to help make sure that you're in a good place. But I have a lot of lenders that'll talk to me and say, hey, I have these people that have, maybe not great credit. And if you're spending too much time coaching them on credit, you're not lending, right? And doing the work that you need to be doing. And so getting, as soon as you kind of know, hey, in X amount of time, I'd like to buy a home, starting to ask those questions and figure out who your team's going to be is super important. Yeah.
And like I see enough credit reports and I know enough to be dangerous, but I'll never take the position of being an expert. So that's why, having somebody like yourself to be able to, provide a referral for these clients that do need some assistance is always really great. And I did just speak with a client yesterday, and I did give him your information. I don't know if he'll reach out or not, but I was like, listen, hey, talk to this person. They may be able to assist you and at least get him on the right path. And he wasn't necessarily like in a rush to buy right now. He's just kind of, some things are happening in his personal life, and he's trying to figure out kind of what he wants to do next. And so
yeah, and if you do know somebody that does need this kind of help, like the best way to refer any of us to anybody is to connect us with them directly. 3-way text, email, back and forth with all of us in one chain. Just say, hey, I just found this person, or I've worked with them before, they did an amazing job. That's the best way to connect a referral, and that will give you, the satisfaction of being like, I at least put it out there for you. We can kind of take on the burden of making sure that they kind of follow through on things. That way it's not you always checking in being like, hey, their cousin with really, really bad credit, are you checking in on all this stuff? And, to make those connections once we post this stuff, I'll have it on my YouTube channel. I'll put it all in the captions below, and make sure that we have, you know, phone numbers, emails, social links, all that sort of stuff. So as you find this, if you need us, we're here to help. You know, we all act as fiduciaries for our clients. We're not salespeople. I
don't like to look at myself like a salesman, not at all.
We are here to help. And I think, you know, Anne-Marie did an amazing job clearing up a lot of stuff. I did a lot of it on my own, self-educating, reading a lot of books, and working with, you know, my wife being kind of the hard head on top of me for, you know, my spending habits I used to have. But we do have professionals like Anne-Marie that can actually come and give you a full analysis and a clear plan and a starting timeline. And then, you know, after you fix and repair, then you can build and save, and then you can purchase, and then you can grow. Mm-hmm. And then you can just continue that trajectory. You know, it's 1-2 years, you know, worth of sacrifice to dramatically change the outcome of what your life potentially could be.
Absolutely. People got to see the big picture.
You know, it's not the end all be all, but you don't want to get to the table and then find out you have terrible credit and then you have all these things. You want to be proactive. And even as someone who came into this knowing stuff about credit, like there's a ton of stuff on the mortgage side and numbers and things that you guys are running and calculating that I'm learning a lot about that, you know, I hope to help my clients with. But the most important thing again is like knowing as early as you can, even if it's 5 years down the line, I want to buy a house, checking in with those people and figuring out where you're at so that you, like Ian said, you can start on that plan and make sure that you're looking at the right credit score. And if it's not what you need it to be, that you're getting it up, because I think people don't realize how, again, credit is the basis for everything. If you have bad credit or you have no credit, you're not going to get access to things. You're going to pay more for things, you know.
That's the biggest thing. You pay more.
Yeah, you're going to have higher.
And interest is a killer.
Yeah,
you know?
Higher interest rates. You're not going to have access to certain financial products if your credit isn't, you know, maybe, you know, meeting the whatever the limits are.
Yeah.
On it.
And it doesn't have to be perfect.
No,
you know?
it doesn't.
No, but I mean, like if you have a low score and you're trying to open an additional credit card to expand your credit history, they're only going to approve you for $1,000. Whereas, you know, when you're ideal in credit, like 760, 780, they're like, well, no, $10,000 sounds about right for you. So we can start you there, and then over time that could build to a $20,000 credit limit, and you're just like, who just gave me $20,000? So this is crazy.
With credits, I was surprised to learn, you know, doing some free educational seminars with loans. It's like, you know, let's say FHA is like 580, but just because you qualify for 580 doesn't mean you're going to be 580 and 5% down, you know, or a really low credit score and 5% down. You know, you might have to have a larger down payment. You might have higher interest rates. So you're going to be paying for that lower credit in other ways. And that's why it's such a key building block for your financial health. And again, you don't want to get to the table and be surprised like, oh, hey, I don't have all these things wrong with my credit. So making that action plan, being curious about credit and educating yourselves, reaching out to me or any of us about your credit questions and how that's going to affect your home buying journey is.
Well, this has all been good stuff. We got to wrap up here. So tell everybody how they can get in touch with you.
For sure. So you can do hello@exitomanagementgroup.com or on Instagram, TikTok, all that stuff. We're just at Exito, EXITO, Credito, CREDITO. Again, we are bilingual, so we can help people in English and in Spanish. And then 786-790-9728. Phone number. So.
Well, thank you. This has been all very good information. Thank you, Neil, for running the board. So yeah, keeping it beard.